Imagine you're driving to work tomorrow morning.
Right, the daily commute.
Exactly. You're settling into the driver's seat. The engine is humming. You've got your coffee secured in that little cup holder.
It's essential.
Oh, absolutely essential. And maybe you have some quiet music playing in the background. The heater is blowing warm air on your feet.
Sounds pretty cozy, honestly.
Right, it is. You pull out of your driveway, you merge onto the highway, and for the most part, everything is just perfectly smooth. I mean, this is the exact same route you take every single day.
You know it like the back of your hand.
You really do. You know every curve of the asphalt. You know where that one really nasty pothole is in the right lane.
So you always dodge it just in time.
Yep, exactly. And you know exactly how long the stoplight at the main intersection lasts. It just feels entirely predictable, It feels safe.
Well, it's a beautifully constructed illusion, really.
An illusion.
Yeah, I mean, we completely rely on that feeling of routine just to get through the day without being, paralyzed by anxiety.
That makes sense.
That comforting bubble of control is a psychological necessity for us as humans.
But if we strip away the psychology for a second, right, and we just look at the raw mechanics of that morning commute, it's actually, it's terrifying.
Oh, it really is.
Because hovering just like millimeters outside that bubble of control is this massive universe of variables that you cannot see and you absolutely cannot influence.
Not even a little bit.
Right. There is a very real possibility of someone in the oncoming lane getting, distracted by their phone and drifting across the yellow line.
Which happens all the time.
All the time. Or maybe there's a deer just standing past the tree line and its nervous system is about to fire a signal telling it to just dart right across your path.
Right, at the worst possible second.
Exactly. Or perhaps the temperature drops a few degrees overnight, water freezes in this little shaded dip in the road, and you hit a patch of black ice at 60 miles an hour.
Yeah, you have absolutely no idea if any of those specific things are going to happen today.
None. But that possibility is just sitting right there in the passenger seat with you.
And that invisible passenger, that lingering, unquantifiable possibility that something could just go horribly wrong.
Even if it probably won't happen today.
Right. Even if it probably won't. That possibility is the entire foundation for our deep dive today.
Yeah.
We are looking at the invisible architecture that keeps society functioning when those possibilities actually materialize.
Welcome to a special insurance study companion edition of our deep dive. Today, we are taking a massive, comprehensive journey right into the absolute core of the insurance universe.
The very center of it all.
Exactly. So whether you are currently staring down a stack of textbooks, cramming for your CPCU exams, or maybe you're a seasoned professional in the industry trying to sharpen up your foundational knowledge.
Or honestly, just an intensely curious person.
Right. Someone who just wants to understand how the modern world manages pure chaos. This deep dive is tailored specifically for you.
Because our mission today is to master a single, deceptively simple word.
We are going to completely deconstruct the concept of risk.
Risk. It is literally the bedrock of the entire global economy.
Really? The entire economy?
Oh, absolutely. I mean, think about it. Insurance exists for one reason and one reason only, and that is because risk exists, period.
Huh.
If nothing uncertain could ever happen in our lives or our businesses, like if every single tomorrow was perfectly predictable, down to the microsecond.
Would all be psychic.
Right. If we were all psychic, there would be absolutely no need for the insurance industry.
Wow.
No underwriters, no actuaries, no policies, none of it. The trillions of dollars moving through the global mechanism of insurance is simply a coordinated mathematical response to the unknown.
Okay, that brings up a really interesting problem, though. Because the way we talk about the unknown in everyday life is completely different from how this massive financial machine talks about it.
Oh, completely different. It's almost two different languages.
Yeah, because to truly understand the insurance industry, we have to start with a massive philosophical shift. We have to break the way you, meaning you, the listener, probably use the word risk in everyday casual conversation.
We have to reprogram that completely.
Right. So let's say I'm hiking through a dense forest. I come around a bend in the trail, and suddenly I am 10 feet away from a massive, angry grizzly bear.
A terrifying situation.
Very terrifying. My immediate visceral reaction is to panic and think, wow, I am in a really high-risk situation.
Because most people think risk is literally synonymous with danger.
Right, exactly. But if I'm sitting for a CPCU exam, That casual definition is going to get me a failing grade, isn't it?
It will absolutely tank your score.
Ouch.
Yeah, it's a really common beginner misconception. And it happens because human biology trains us to conflate the actual threat with the uncertainty.
Okay, unpack that for me.
When you are staring at that grizzly bear on the trail, you are looking at a danger. The danger is a condition. It is a physical reality standing right in front of
Yeah,
you.
very large teeth.
Right. But risk. In the technical vocabulary of insurance, risk is entirely about the uncertainty.
Wait, so the bear itself isn't a risk?
The formal CPCU definition, and this is a sentence every student must permanently carve into their brain, is this. Risk is the uncertainty concerning the occurrence of a loss.
The uncertainty concerning the occurrence of a loss.
Exactly. Let's break that apart.
Yeah.
It is the possibility that the actual outcomes of a situation will differ from your expected outcomes.
Okay.
When we talk about risk in insurance, we are specifically talking about the chance that an individual, or maybe a business or an organization, will suffer a financial or economic loss due to an uncertain event.
So it's not the bad thing happening, it's the not knowing if the bad thing will happen.
Yes.
The risk is basically that space between the present moment and the potential disaster. Will a loss happen? When is it going to happen? How severe is it going to be when it finally does?
To look at it from a broader linguistic perspective, actually, the Chinese translation of the concept captures this beautifully.
Oh, really? What is it?
They define risk conceptually as future loss uncertainty.
Future loss uncertainty. I like that.
Right. That phrasing focuses the mind heavily on the fact that you simply do not know if, when, or how badly an event will strike.
Right. Yeah.
I mean, a house might catch fire, a car might get into an accident, a business might suffer a catastrophic cyber attack that wipes all their servers.
The operative keyword in all of those scenarios is might.
Might. Because none of those disasters are guaranteed.
Yeah, a house can stand for 200 years and never see a single spark.
Exactly. They do not have to happen. But if they do happen, they cause profound economic damage.
Okay.
Therefore, because we just don't know, and because the consequences are really severe, they represent risk. So let's apply this back to your hiking trip.
Okay, let's fix my bear encounter.
When you are standing face to face with the angry bear, the uncertainty is largely gone.
Yeah, I'm pretty certain I'm in trouble.
Right. The danger is acutely present. The cause of your imminent loss, whether that's medical bills or, well, worse, is staring you right in the face.
Yeah. So where was the risk?
To an insurance professional, the risk was what existed before you ever stepped foot into the woods.
Oh, I see.
The risk was the overarching uncertainty sitting in your living room while you packed your bag of whether or not a bear encounter would happen that day.
So the uncertainty was the risk. The bear is just a danger.
Exactly. Let's look at another classic scenario from our study materials. A snowy, slippery highway.
Okay, so the snow and the ice on the asphalt, that is the danger.
The snow is a physical condition. The risk is the possibility, that lingering uncertainty, that the slippery condition might actually lead to you losing control and crashing your car.
I love this memory tool from our research because it makes an abstract concept so brilliantly visual for you.
The punctuation one.
Yes. Think of risk as a giant hovering question mark.
I love that.
Will a loss happen? That question mark floating over your house, over your car, over your small business, that is the risk.
And the loss.
The loss, on the other hand, is an exclamation point. It already happened. The house burned down, the car crashed, the server was hacked.
The question mark versus the exclamation point is just a fantastic heuristic.
It really is.
Risk is the uncertainty that exists before the event. Loss is the tangible, measurable damage that exists after the event. You are moving from a state of not knowing to a state of absolute, painful certainty.
But this distinction between the question mark and the exclamation point, I mean, that's just the entry ticket, isn't it?
Oh, definitely.
Because once you get into the actual coursework for something like the CPCU, the terminology gets incredibly granular. Anyone studying for these exams is going to know exactly what I mean here.
They test it ruthlessly.
The test creators love to prey on casual vocabulary. It's what I call the great mix-up.
The CPCU exams deliberately test the boundaries of your vocabulary. I mean, if you are taking CPCU 500 on managing evolving risks, or 520 on insurance operations, 530 on business law.
Or 540 on finance and accounting.
Exactly. These foundational courses demand absolute precision. You will rarely see a question that simply asks, what is the definition of risk?
That is way too basic.
Far too basic. They want to see if you can untangle 4 deeply intertwined concepts that sound completely identical to a layperson.
We are talking about risk, loss, peril, and hazard.
Those four terms are the four horsemen of the insurance exam.
The four horsemen, that's a good way to put it.
The test will present you with a complex scenario and ask you to identify which element is the peril and which is the hazard. And if you rely on your gut instinct, you will probably get it wrong.
So let's build a continuous cinematic narrative out of that snowy road example to really lock these four terms in place.
Good idea.
Because reading definitions in a textbook makes them all just blur together into a general sense of, like, something bad is happening.
Right.
So let's put me back in the driver's seat. I'm driving through a mountain pass in a blizzard. The snow is coming down hard, it's freezing to the asphalt, and the road is becoming incredibly slick.
Setting the scene.
Yep. So in CPCU terms, the physical condition of that icy road, the thing that makes an accident much more likely to happen, that is the hazard.
A hazard is a condition that increases the probability or the severity of a loss.
Okay.
The snowy road doesn't inherently crash your car all by itself. A car can sit safely on a snowy road forever.
That's true.
But the ice drastically increases the chances that a crash will happen if you try to stop suddenly.
So I keep driving, I hit a patch of that black ice, my tires lose traction, I spin completely off the road, and my front bumper smashes into a large oak tree.
Ouch.
Yeah. The actual event of the collision, the direct, immediate cause of the damage to my vehicle, that is the peril.
The peril is the active agent of destruction. It is the direct cause of the loss.
Direct cause.
Right. Common perils in the property and casualty world are things like fire, windstorm, flood, theft, or in your scenario, an auto collision. The peril is the mechanism that strikes.
Following the timeline, the tow truck arrives, pulls my crumpled car out of the ditch, and drags it to the mechanic.
And then comes the painful part.
Right. A few days later, the mechanic hands me an itemized repair bill for $5,000. That economic damage, that quantifiable financial hit to my bank account, that is the loss.
The loss is the economic aftermath. It is the exclamation point we discussed earlier.
The exclamation point.
The event is over, the peril has finished its work, and now you are left with a measurable reduction in your wealth.
So we have the hazard, which is the ice. We have the peril, which is the collision. And we have the loss, which is the repair bill.
Which brings us back to our core question.
Right. Where was the risk in all of this?
The risk was the invisible cloud hanging over the entire morning. The risk was the overarching uncertainty of whether any of this narrative would unfold the moment you turn the key in the ignition.
Ah.
Would the hazard, the ice, lead to the crash? Would the peril cause a loss, the repair bill? You didn't know.
I had no idea.
That state of not knowing, that suspended animation of potential outcomes, was the risk.
There is a golden rule from our sources that every single test taker needs to repeat in the mirror every morning. Peril causes loss. Risk is the uncertainty that the loss may occur.
It is the most commonly tested trap because the English language encourages us to mix them up.
Yeah, people say, oh, fire is a huge risk for this old wooden building.
Exactly. In insurance, fire is a peril.
Yeah.
It causes the loss of the building.
Right.
Risk is simply the uncertainty of whether the building will catch fire in the first place.
That makes perfect sense.
If you can firmly separate the active cause, the peril, from the mathematical uncertainty, the risk grab, you will navigate a massive portion of the exam questions successfully.
But I want to zoom out because this isn't just an academic exercise designed to torture students taking multiple choice tests.
Right. It has real-world applications.
Massive ones. This seemingly abstract concept of uncertainty practically dictates the behavior of multi-billion-dollar institutions. It is the engine of the entire global insurance industry.
It really is.
So to understand how insurers view risk, we have to look at the four main pillars of their operations, which are underwriting, pricing, claims, and regulation.
Once you realize that insurance companies are essentially massive, sophisticated uncertainty processing machines, the entire structure of the industry makes perfect sense.
Uncertainty processing machines. I like that. Let's look at the front door of that machine. Underwriting.
Underwriting is basically the sorting mechanism. It's the process of assessing an applicant and deciding what to do with them.
When a person or a business applies for an insurance policy, the underwriters act as the gatekeepers.
Right. Their entire job is to look at the applicant and evaluate their specific level of uncertainty regarding a future loss. They are detectives trying to quantify a question mark.
Quantify a question mark.
Yeah, let's say an applicant has multiple recent at-fault car accidents on their motor vehicle record. The underwriter looks at that data and determines the applicant presents a very high probability of future loss.
So the uncertainty is skewed heavily toward disaster.
Exactly.
So how does the underwriter respond to that data?
Well, they have to protect the financial stability of the insurance pool, right?
Right. Yeah.
So they will respond by either charging a drastically higher premium to compensate for the higher probability of paying out a claim, or if the uncertainty is simply too severe, they will deny coverage altogether.
Oh.
Conversely, an applicant with a spotless driving record who keeps their car parked in a secure garage presents very low uncertainty. The underwriter rewards that low risk with a lower premium.
Wait, if the underwriters are sorting people into these risk categories, how do they actually know how much money to charge them?
That is the big question.
Because that feels like the ultimate financial tightrope walk. You are essentially asking a corporation to mathematically predict the future.
That is the domain of the actuaries, and it brings us to the second pillar, pricing or rate making.
Rate making.
And you're right, it is an incredibly high-stakes tightrope walk. The insurers must predict the future frequency and severity of losses accurately across millions of individual policies.
Are you?
Right. They use the law of large numbers, analyzing massive sets of historical data to predict future trends. But think about the catastrophic consequences of getting that mathematical prediction wrong.
Okay, let's say they get overly optimistic. They underestimate the risk of a certain demographic.
If they underestimate the uncertainty, they charge premiums that are too low.
So they collect like $100 from everyone, assuming only one person will crash.
Right. But what happens when the uncertainty becomes reality and 10 people crash?
Oh.
They haven't collected anywhere near enough money in the premium pool to pay those claims. The company bleeds capital, its reserves deplete, and it faces insolvency.
But they can't just jack up the prices to protect themselves, can they? I mean, what happens if they get paranoid and overestimate the risk?
Then they charge premiums that are far too high. They demand $500 for a policy that should cost $50.
And in a competitive free market?
The customers simply leave. They go to a rival insurer whose actuaries priced the uncertainty more accurately. So the pricing department is constantly balancing on this razor's edge, trying to perfectly match the dollar amount of the premium to the precise microscopic level of uncertainty.
This leads us to the third pillar, and honestly, this is where the philosophy of insurance gets fascinating to me. Claims.
Claims are where it gets real.
Right, because when an average person thinks about an insurance claim, they just think about money going out the door, the insurer writing a check and being annoyed about it.
Yeah, that's the standard view.
But conceptually, based on everything we've defined, a claim is a profound moment. A claim is the exact moment in space and time when risk transforms into loss.
It is the materialization of the unknown. It is the moment the hovering question mark violently crashes down and becomes an exclamation point.
And crucially, a claim isn't just money leaving the building, it's a massive feedback loop.
It is the lifeblood of the pricing model. When a claim happens, the insurance company doesn't just pay it, file the paperwork, and forget it ever occurred. That claim becomes a crucial new data point. That loss data flows directly back to the actuaries and the underwriters.
It tells them, hey, this event that our models thought was nearly a remote possibility, it happened.
Exactly. And here's exactly how much it costs to fix. That granular data helps them reevaluate their models and reprice future risks. The painful claims of today are the exact tools used to refine the risk assessment of tomorrow.
It's like an organism constantly learning from its own injuries. Every time it gets hurt, its immune system, the actuaries adjust to make sure it's better protected next time.
That's a very visceral analogy, but it's incredibly accurate. The entire industry is a learning machine fueled by disaster data.
But here is the terrifying vulnerability of that entire machine. What if the machine guesses wrong on a massive scale? Like what if a hurricane wipes out a coastal city or a global pandemic shuts down every business at once? You can't just trust these companies to perfectly predict the future and always have enough cash in the vault to pay millions of claims simultaneously.
You absolutely cannot trust them blindly. And that vulnerability is exactly why government regulators step in.
The fourth pillar.
This is our fourth pillar, regulation. Regulators understand that an insurance policy is essentially a piece of paper containing a promise to pay for future uncertainties.
Right.
But that promise is entirely worthless to the consumer if the insurance company goes bankrupt an hour before the loss occurs.
Yeah, that would be completely useless.
So state regulators impose incredibly strict financial rules based on the specific risks a company has taken onto its books.
The technical terms that CPCU students need to know here are things like risk-based capital or RBC and solvency monitoring. How do those actually work in practice?
Risk-based capital is a formulaic safety net. Regulators don't just ask an insurer for a flat deposit. They look at the specific granular risks an insurer has assumed in their overall portfolio.
Give me an example.
Well, writing policies for offshore oil rigs faces a fundamentally different level of catastrophe risk than an insurer writing basic dental policies.
Oh, absolutely.
The regulators mathematically calculate this, and they legally require the insurer to hold a specific, proportionate amount of capital, actual cash, or highly liquid assets in a locked reserve.
So they literally lock it away.
Yes, this ensures they can pay out claims even in extreme worst-case scenarios.
So the higher the risk in their portfolio, the more of their own money they are legally forced to keep locked away in the vault.
Precisely. And solvency monitoring is the ongoing aggressive process of auditing those reserves to make sure the company remains financially healthy enough to survive the uncertainties they've promised to cover.
It is the government enforcing the mathematics of risk.
That's a great way to summarize it.
All right, we spent a lot of time looking at this from the top down. We've looked at how the giant multi-billion-dollar insurers view and handle risk through underwriting, pricing, claims, and regulation.
Right, the macro view.
Let's flip the camera around. How does an individual person or a small business deal with this reality on the ground? Because we all face these hovering question marks every single day. This brings us to a framework our sources call the risk management menu.
Risk management is the broad, overarching process of identifying, analyzing, and treating risks before they become losses.
Okay.
Once you identify a risk in your life or your business, you generally have 4 basic techniques.
Okay.
4 menu options for how to handle it: avoid, reduce, transfer, or retain.
Let's stick with our morning commute driving analogies because they map perfectly onto these concepts.
Let's do it.
The first option on the menu is to simply avoid the risk entirely.
Avoidance is the most foolproof method, but it is often the least practical.
Why is that?
Well, if the risk is the uncertainty of getting into a car crash on the highway, how do you completely avoid it? You simply never get in a car. You don't own one. You don't ride in one as a passenger. You don't even walk near a road.
So the probability of the loss drops to absolute mathematical 0.
Exactly. But the opportunity cost is massive.
Yeah, you can't go to work, you can't visit your family, you become a hermit. It's not a viable option for a functioning adult in modern society.
Usually not.
So, since we can't avoid it, we move to option 2 on the menu. Reduce.
Reduction means you accept the underlying activity, but you take proactive steps to lower either the probability of the loss occurring or the severity of the loss if it does occur.
So I decide I must drive to work.
Right. But you choose to drive the speed limit. You invest in high-quality snow tires. You always wear your seatbelt.
You buy a modern vehicle with advanced side curtain airbags and automatic emergency braking.
Yes, you are actively altering the physical hazards, which in turn reduces the overall risk.
You're shrinking the size of the question mark, but you haven't eliminated it entirely.
Right.
Which leads us to option 3, transfer. And this is the fundamental light bulb moment for anyone studying this field. When you log onto a website and buy an auto insurance policy, what you are fundamentally doing is choosing the risk transfer technique from this menu.
That is the core transaction.
Yeah.
You are saying to the insurance company, look, I cannot avoid driving because
Right.
I need my job. I have reduced my risk as much as humanly possible with snow tires and defensive driving. But there is still a residual uncertainty.
There's still a risk of a catastrophic $50,000 medical and repair bill that would bankrupt me.
Exactly. So I'm going to pay you a known, fixed, manageable amount, my monthly premium, and in exchange, you legally agree to take this massive financial uncertainty off my shoulders.
I am transferring the economic consequences of this risk to your balance sheet.
Perfect. And the final option, number 4 on the menu, is retain.
Retain.
Retention means you simply keep the risk yourself. You accept the uncertainty. If you get into a crash, you will pay the repair bill entirely out of your own savings account.
Wow, that sounds risky.
Well, it's important to note that people almost always use retention in combination with transfer.
Like a deductible.
Exactly like a deductible. If you have a $500 deductible on your auto policy, you are consciously choosing to retain the first $500 of the risk.
You are saying I will handle the small uncertainties.
Right. And you are transferring the catastrophic remainder of the risk above that amount to the insurer.
Okay, if risk transfer is just paying someone else to take my uncertainty, I have a theoretical question.
Go for it.
Why can't I buy an insurance policy that pays out if my new startup company goes bankrupt? I mean, Starting a business is incredibly uncertain. The risk is huge. I want to transfer it. Why won't an underwriter touch that?
That's a great question, because you are asking them to insure the wrong category of risk.
The wrong category.
Yes. The insurance industry is built almost entirely on handling one specific classification of risk and fiercely avoiding another. We are talking about the difference between pure risk and speculative risk.
This is a massively important distinction for the CPCU exams. Let's break down pure risk first.
Pure risk is a scenario where there are only two possible outcomes. Either a loss occurs or no loss occurs.
So black and white.
Very black and white. You remain at the status quo or you suffer damage. There is absolutely no possibility of making a profit or experiencing a financial gain.
So my house burning down is a pure risk.
Yes. Your house either burns down, resulting in a devastating loss, or it doesn't burn down, and you simply continue living there.
Your car either crashes or it doesn't.
Exactly. You either suffer a sudden heart attack or you don't. These are pure risks.
Got it.
Because there is no underlying opportunity for financial gain, these are the risks that insurance companies are willing to accept, calculate, and cover. The entire mechanism of insurance is designed for indemnification.
Indemnification, what does that mean exactly?
It means restoring you to the exact financial position you were in just prior to the loss. It is designed to make you whole, not to make you richer.
Okay, so then speculative risk is the opposite. Let's go back to my startup idea. I take my entire life savings and launch a new tech company. Or I take all my money and put it into highly volatile cryptocurrency.
Right.
I am definitely facing a mountain of uncertainty. I could lose every penny.
But look at the potential outcomes. With a speculative risk, there are three possible outcomes, not two. You could suffer a total loss and go bankrupt. You could have no loss and simply break even. Or, and this is the critical disqualifying part, you could experience a massive financial profit.
The simple possibility of me getting rich makes it speculative.
Yes, if you launch a startup, it could fail, but it could also become the next billion-dollar tech unicorn.
Or if I buy volatile stocks, they could crash, but they could also skyrocket.
Speculative risk involves a conscious, voluntary choice to embrace uncertainty, specifically in the hopes of a financial reward.
And the traditional insurance industry looks at that upside and just refuses to play.
They have to refuse. Because of that potential for gain, speculative risks are fundamentally uninsurable by traditional property and casualty or life and health insurance models.
Because it violates that indemnification principle.
Completely violates it. Think about the mechanics. If an insurance company insured your stock portfolio against any losses, but allowed you to keep all the gains if the stock went up.
Oh, wow. The economic incentives would completely collapse.
Instantly. Everyone would take the most reckless, high-risk gambles imaginable, knowing the insurer would absorb the losses while they pocketed the wins.
It would basically be a casino where you can never lose a hand, but the house goes bankrupt in an hour.
Precisely. And that's why insurers draw a hard, bright line at pure risk.
All right, this has been a lot of high-level theory. We've dissected pure versus speculative risk, the nuances of risk transfer, the difference between perils and hazards, and the philosophy of question marks and exclamation points.
We've covered a ton of ground.
We really have. So I want to take all of this textbook knowledge and stress test it against a single, highly realistic scenario. Our sources provide a great real-world case study that brings all these abstract concepts violently into contact with the messy reality of human behavior.
Grounding the theoretical frameworks in a practical scenario is the absolute best way to ensure you've mastered the material for the exam.
So let's look at it.
What's our scenario?
We have a driver applying for a standard personal auto insurance policy. Let's look at the variables the underwriter is staring at on their screen.
Okay.
The applicant is an 18-year-old male. He has a grand total of 6 months of driving experience. He already has 2 at-fault accidents on his motor vehicle record.
Oh boy.
And to top it off, he lives and commutes in a dense, highly congested, high-traffic urban area.
Okay, if we run this profile through the lens of risk classification, which is the actuarial process of grouping similar risks together to establish statistically fair rates, this applicant is a textbook nightmare for an underwriter.
The insurer's algorithm looks at this kid and immediately slaps a giant, flashing high-risk label on his file.
Without hesitation.
Why so fast?
The underwriters are evaluating the uncertainty of future loss. And look at the sheer volume of hazards present here. His youth implies a lack of maturity.
Right.
His mere 6 months of experience is a massive hazard. His proven track record of 2 prior accidents indicates a serious behavioral pattern.
And the dense, crowded urban environment he navigates daily is an environmental hazard.
Exactly. All of these conditions layer on top of each other to dramatically increase the mathematical probability that he will suffer another loss in the near future.
So how does the machine respond? What is the tangible, real-world consequence of that high-risk classification?
The underwriting department has a few levers they can pull to protect the company's capital. The most common response is to significantly inflate the premium.
Make him pay more?
Yes, if the statistical probability of the insurer paying out a claim is incredibly high, the cost of the risk transfer must be proportionately high to fund the reserve.
That makes sense.
Alternatively, they might hike up his deductible to, say, $2,000, essentially forcing him to retain a much larger portion of the risk himself.
Gotcha.
Or, if they feel the uncertainty is simply too chaotic to price accurately, they will utilize the avoidance technique. They will decline coverage outright and refuse the transfer.
But let's dig into the psychology here. Because humans aren't just passive data points sitting on an underwriter spreadsheet waiting to be priced, right?
No, humans act in their own self-interest.
Exactly. And this brings us to two advanced behavioral concepts that the CPCU exams test relentlessly because they define the invisible war the insurance industry is constantly fighting. The first concept is adverse selection.
Adverse selection is one of the most fascinating psychological and economic phenomena in the entire financial sector.
It really is.
It fundamentally answers the question, why do the people most likely to crash their cars desperately want to buy the most insurance?
It makes intuitive sense when you think about it. If I am an incredibly safe, boring driver who has never had a ticket in 20 years, I might look at a massive premium and think, do I really need all this extra coverage? I never crash.
Right, you might just buy the state minimum.
But if I am that 18-year-old kid and I secretly know I'm a terrible driver who gets distracted easily, I know I'm probably going to crash again.
So you want the absolute maximum platinum tier coverage possible.
Exactly.
You've perfectly described the dynamic. Adverse selection is the statistical tendency for individuals who know they have a higher than average probability of loss to actively seek out insurance at standard average rates.
Standard rates being the key there.
Yes. It relies on a concept called asymmetric information. The 18-year-old knows his own bad habits better than the insurance company does.
He knows he is a high risk, but he desperately hopes the insurance company's algorithm doesn't realize it.
What happens if the insurance company's algorithm is broken and they don't catch him?
Oh, that sounds bad.
That is the doomsday scenario for an insurer. If an insurance company fails to properly classify risks, let's say they offer the exact same average rate to the 18-year-old with 2 accidents as they do to a 45-year-old accountant with a spotless 20-year record, the market reacts instantly.
Oh, so.
All the high-risk drivers will flock to that company to buy the underpriced policy. Simultaneously, the low-risk drivers will realize they are paying too much to subsidize the bad drivers, and they will leave.
So the insurance company's risk pool becomes entirely polluted. They get stuck with all the bad risks, they pay out massive claims, and they spiral into bankruptcy.
Precisely. That economic death spiral is why rigorous underwriting and accurate risk classification are so vital.
It's life or death for them.
They are the primary defense mechanisms against adverse selection. They have to correctly identify the 18-year-old, label the hazards, and charge him appropriately so the financial ecosystem remains balanced.
Okay, that makes total sense for the behavior before the policy is purchased. But what about the behavior after the paperwork is signed?
Oh, yeah.
Let's say our 18-year-old accepts the massive premium, he pays the money, he now possesses full comprehensive coverage. This brings in the second massive behavioral concept, moral hazard.
Moral hazard is a psychological shift that occurs within the insured person precisely because the risk transfer has successfully taken place.
It's a subconscious behavioral change.
Yes. The question you have to ask is, does the mere possession of a great insurance policy make our 18-year-old drive just a little bit more recklessly simply because he knows he is financially insulated?
I mean, if he's driving a beat-up car with no insurance, he's terrified of a scratch.
Right.
But if he knows he has full coverage, the thought process becomes, hey, if I total this car by taking this corner too fast, it's fine. The insurance company will just write a check and buy me a new one.
Exactly.
Yeah.
A moral hazard is a condition where the existence of an insurance policy actually changes the insured's behavior, leading them to act less carefully.
Interesting.
And ironically, this decreased caution drastically increases the frequency and severity of the very risk the insurance company just agreed to take on.
It's almost a self-fulfilling prophecy.
It's important to note that this isn't necessarily about outright criminal insurance fraud, like intentionally setting your car on fire for a payout.
Right, that's different.
While that happens, moral hazard is much more insidious. It's often a subconscious relaxation of caution.
It's the slight modifications in daily habits.
Exactly. They might drive 10 miles an hour faster on that snowy road. They might park their car in a sketchier neighborhood and forget to lock the doors, simply because the devastating financial sting of a stolen car has been removed from their personal equation.
They transferred the risk to someone else's balance sheet, so they no longer respect the physical danger in front of them.
That is a brilliant distillation of the concept. They transferred the risk, so they no longer respect the danger.
Wow.
And insurers have to constantly aggressively battle moral hazard. One of their primary weapons is the deductible, which we touched on during the risk management menu.
Because a deductible forces you to retain some of the pain.
Yes. If the 18-year-old knows that, despite his expensive policy, he still has to pay the first $1,000 of any crash out of his own checking account, that retains a significant amount of the financial sting.
It forces him to keep some skin in the game.
Exactly. That personal financial exposure is often just enough to make him hit the brakes a little earlier on that icy road, which effectively mitigates the moral hazard.
It is genuinely incredible how all of these seemingly disparate concepts interlock to form this massive financial architecture. You start with this incredibly simple, almost philosophical definition of a question mark, the uncertainty regarding a loss.
And you end up here.
Yeah, by pulling on that single thread, you are suddenly unpacking the psychological flaws of a teenage driver, exploring the economic theories of asymmetric information, and understanding exactly why a multi-billion-dollar corporation uses deductibles as a behavioral modification tool to force a kid to drive safely.
It is a massive, interconnected ecosystem built entirely on managing the unknown.
Yeah.
And I promise you, once you truly understand this core mechanism of risk, every other concept you study in your CPCU journey, from the complex legal liability frameworks in Course 530 to the dense corporate financial modeling in 540 suddenly snaps into place.
It all comes together.
It all traces back to this foundational idea of pricing the question mark.
Okay, speaking of the CPCU exams, I want to make sure we lock this in. Let's run through a rapid-fire conceptual review to cement these ideas before we wrap up. We want you to walk away from this deep dive with these key takeaways permanently etched in your memory for test day.
Let's do the final review.
First, the absolute core definition. If the exam asks, what is risk?
Risk is the uncertainty concerning the occurrence of a loss. It is the possibility that actual outcomes will deviate from expected outcomes.
Second, why is this abstract concept so fundamentally important to the industry?
Because it is the central engine of every major function. It dictates underwriting decisions, drives actuarial pricing models, is resolved through claims handling, and is strictly monitored by government regulation. It is the sole reason the industry exists.
Third, the most heavily tested distinction, the vocabulary trap you absolutely must not fall into.
Do not confuse risk with peril, hazard, or loss. Remember the causal chain. A hazard, like ice, increases the likelihood of a peril. A peril, like a collision, is the direct cause of the loss. The loss is the economic damage. Risk is simply the overarching uncertainty that any of it will happen.
And finally, our visual memory tool.
Risk is the question mark, the uncertainty hovering over you before the event. Loss is the exclamation point, the tangible, finalized economic damage after the event.
I love it. Okay, as we bring this deep dive to a close, you know we always like to leave you with something a bit more profound to chew on. We spent this entire time talking about how the insurance industry relies entirely on the existence of the unknown to function. The whole machine runs on uncertainty.
If nothing uncertain could happen, there would be no need for insurance. We established that premise at the very beginning of the hour.
Right. But I want you to think about the technological direction the world is hurtling toward right now.
That's moving fast.
We are entering an era of unprecedented artificial intelligence, machine learning, and massive, ubiquitous data collection. Modern cars are basically rolling supercomputers, tracking every millimeter of the road, every micro-adjustment of the steering wheel.
Smart homes monitor every wire, every pipe, every fluctuation in temperature?
Exactly. We have AI models that are becoming startlingly, almost uncomfortably good at predicting human behavior, traffic patterns, and micro-weather events.
Which raises an incredibly provocative, almost existential question for the industry we've just spent an hour deconstructing.
Exactly. What happens to this entire multi-trillion-dollar industry in a theoretical future where technology becomes so advanced that it essentially perfectly predicts these outcomes?
It's a huge question.
What happens when the AI in your car can tell you with 99.9% certainty exactly which part is going to fail next Tuesday, or exactly which intersection will have a catastrophic crash based on real-time traffic flow data?
If we eventually use technology to completely eliminate the question mark, do we eliminate the need for the insurance industry entirely?
If the uncertainty approaches zero, the risk approaches zero.
Or does the industry simply mutate into something completely different? Perhaps it transforms from a financial risk transfer mechanism into a mandatory, algorithmically driven maintenance and prevention service.
It's a wild thought. If certainty replaces uncertainty, the whole engine shuts down. We want you to mull that over during your commute tomorrow morning. As you pull out of your driveway, merge onto the highway with your coffee, and look around at all those comforting, predictable routines, just ask yourself, how much of my world is actually certain and how much is just a well-managed question mark? Until next time, keep diving deep.